Section 1250 is the real estate cousin of depreciation recapture. It applies to depreciable real property used in a business or held for investment. Think rental buildings and commercial buildings. Land is never Section 1250 because land isn't depreciable. On the EA exam, they'll try to sneak in personal use real estate. If it's a personal residence, Section 1250 doesn't apply. To compute gain, you start with adjusted basis. For Section 1250 property, adjusted basis is usually cost minus straight-line depreciation taken. Then, compare sale price to adjusted basis. Sale price minus adjusted basis equals total gain realized. Exam tip: don't subtract depreciation twice. Depreciation already reduced basis, so it shows up automatically in the gain calculation. Here's the twist. When you sell depreciated real estate at a gain, the depreciation portion isn't taxed at ordinary rates like Section 1245. Instead, it becomes unrecaptured Section 1250 gain. That piece is taxed at a maximum 25% rate. Any remaining gain above depreciation is regular long-term capital gain, usually at 0%, 15%, or 20%. Mechanically, you split the gain into two buckets. Bucket 1 is unrecaptured Section 1250 gain, equal to the lesser of total gain or accumulated depreciation. Bucket 2 is the leftover long-term capital gain. If there's no gain, there's no unrecaptured Section 1250 gain. And if the property sells at a small gain, you can't have more unrecaptured Section 1250 gain than the gain itself. Run the classic numbers. Buy a building for $200,000. Take $50,000 straight-line depreciation. Adjusted basis is $150,000. Sell for $360,000. Total gain is $210,000. Unrecaptured Section 1250 gain is the depreciation $50,000, taxed up to 25%. The remaining $160,000 is regular long-term capital gain. On the EA exam, this split is the whole point. One last exam trap. Don't confuse Section 1250 with Section 1245. Section 1245 is depreciable personal property like equipment and vehicles. Recapture is ordinary income up to depreciation. Section 1250 is depreciable real property. Depreciation generally becomes unrecaptured, Section 1250 gain at up to 25%, not ordinary. If you see building or rental property, your brain should say Section 1250 and 25%. Bianca owns a dog grooming business as a sole proprietor. This year, she has gross receipts of $63,000. She pays $6,000 of wages, has $7,200 of supplies, and $1,500 of utilities. She also has a $2,200 Section 1231 gain from selling equipment, and she made a $3,100 charitable contribution. How much business income should she report on Schedule C? Think about what belongs on Schedule C versus elsewhere. The answer is $48,300. Schedule C income is gross receipts minus ordinary and necessary business expenses. $63,000 minus $6,000 minus $7,200 minus $1,500. The Section 1231 gain is generally reported on Form 4797, not as Schedule C receipts. The tempting wrong move is subtracting the charitable contribution on Schedule C, but that's generally an itemized deduction on Schedule A. Which of the following is not Section 1245 property? Livestock held for breeding purposes, farming machinery, an office building, or computer equipment. Think about the big dividing line between personal property and real property. The answer is the office building. Buildings are real property, so they generally fall under Section 1250, not Section 1245. The tempting wrong choice is livestock, but certain livestock used for breeding can be treated as business property and can fall under the depreciation recapture rules tied to Section 1245 concepts on the exam.